Welcome to this roundtable. I've got a powerhouse of credit union leaders with me today. Thank you everyone for joining in. Today's conversation will be about 2026 priorities amidst 1,000 things that are happening around. So let's talk about priorities. And we have curated a group of credit union leaders across different verticals, starting with Fred. Hi, Fred. Fred is the Chief Operations Officer of Langley Federal Credit Union, based in Virginia. We've got Miriam. Hi, Miriam. Hi. Miriam is Chief Lending Officer of Addition Financial, Florida based. Then we've got Anand here. Hi, Anand. Anand is the CFO, also leads product strategy and analytics for Citadel Credit Union based in Pennsylvania. We've got Radha. Radha is the CIO of Affinity Plus Credit Union based in Minneapolis. So that's pretty much today's group is. So today's discussion again is talking about priorities, and it will be a round robin. As you know, we've done this earlier. We start with one question and then we ask all our guests to chip in and share their opinion on what we think about as a group. So maybe in the interest of time, I know we are late by 5 minutes because we're trying to figure out the logistics. So apologies for that. I should have managed it better. But in the interest of time, let's start. So let's start with the first group of questions, of the first question that I want to start asking with maybe Anand. So Anand, since you lead strategy analytics as well as products for Citadel, right? As well as wearing the hat of a CFO. So my question to you to start with would be, what is the single most important growth priority that your leadership team is funding for this year? I mean, I know there are a few, but if you want to elaborate on them, and then we can go and ask the same question to the entire group.
Yeah, so that's hello everyone. That's a very broad question if you take it that way. But I will stick with the way that you have framed it, which is what is the single biggest growth priority that we are funding? And if I think about funding, I'm going to say human capital is the single largest, followed by technology. And that's the thing we have funded. And if I stick with why and by how much as a size, in the year 2025, invested, I'm going to use the word invested or funded, about 20 basis points of margin on human capital and technology growth. And that 20 basis points could have flowed to the bottom line had we not made that investment. But then the return on that investment, as you can imagine, is expected over time. And so that's last year. This year, again, a slightly less than that, but about the same kind of investment, both in human capital and technology. Then you might wonder, where is that investment, in what products or what lines of business? I'll say, if I sort of cascade it down from overall human capital plus technology, the second layer of thinking is it's on both front end and back end. And by front end, I mean retail, member facing, and within that, both consumer as well as business banking. For us, the three top growth lines of business include business banking, wealth management, and consumer. So we're staffing up on both sides, but more on the front end, but also on the back end. And by back end, I mean enablers of growth. And that can include risk, that can include finance, that can include analytics. It includes member experience. It includes even support for the front end, so sales support. So all of those things collectively, I put that under human capital as an investment. And we cannot talk about growth without talking about quality of growth. And I don't think we need to remind ourselves, as a credit union, not a bank, we don't have the liberty to be raising capital for growth. We can't drag on loss-making annual P&Ls and then fill it up or replenish through capital raised externally to accelerate growth. We do have to be mindful that our net worth growth has to keep pace with our top line growth. So it's growth plus quality of growth. So that's I guess, a nicely fit out shell in a summary for where we're investing.
Interesting. Fred, you want to add your 2 cents?
No, I think similar buckets, people and technology. A lot of the people are going to be in technology, just making sure we've got all the, support people we need in place to handle growth, to scale growth. Of course, a lot of the initiatives are in technology, like throughout the organization. It's not just in marketing or ops, it's kind of across the board. And so, I would echo what Anand just said in terms of those two.
Right. Absolutely. Miriam or Radha, you want to add your 2 cents? What do you think?
Yeah. So for us, it really is technology. We are just in the process of wrapping up a merger that we really focused on for most of 2025 with a system conversion coming in about a month. So we had a lot of projects that were delayed because our focus was primarily the merger over the last year. So we have a ton of technology initiatives that we're rolling out this year, such as a new collection system to create more efficiency, a new phone system with some embedded chat in there to hopefully alleviate some of the resources from our contact center having to take those calls. We're really focused on commercial. That's one of our big pushes for our next 5 years is we're bringing in treasury management services this year and also a commercial LOS. So those are some of the big pushes where we're investing this year. And it's really about efficiency, being able to meet members where they are and really just doing it with less human resources to provide faster service.
Yeah, that was a big thing you guys were focused on about the merger. But again, congratulations on getting the merger to the finish line. That was huge. And that would have been the obvious priority. Absolutely. Radha, what do you think?
It's very similar, right? In terms of the human capital investment, in terms of the number of open headcounts that, we are planning to fill, that is definitely the biggest line item, followed by technology. Our technology is obviously more geared towards, AI, a lot of data and analytics components that, we are working towards. And that's the next set of large investment. And the third piece that I would say is also, we just did implementation earlier last year, in fact, a year today, a new digital platform, and that continues to grow. And the entire technology investment is all around member experience and growing our members, especially trying to attract that younger membership. We are growing very healthily for a credit union our size. It's just that, how do we kind of attract that younger, member segment? And that is where our focus from technology investment is going to be heavily leaning toward.
Right. So this is a very well-rounded answer that all of you provided from all the lenses. I mean, that's the reason we got a unique mix of leaders, right, across operations, technology, lending, analytics, products. So this was an amazing way to start the roundtable, right? Now let's focus on maybe Fred. One of our favorite discussions we have is growth, right? About how do you acquire net new members every day in a more innovative way. Since we're competing against the world, we're just not competing against other credit unions. That's a very wrong word to use. We're not competing with other credit unions, but we're competing against everyone in the world, be it Chime on one side to Chase on the other side, right? It's not easy. So Fred, my question is across marketing, right? So how is your marketing and member acquisition strategy evolving to drive actual measurable ROI this year?
Yeah, so actually picking up on a comment Anand made about quality of growth, we made the decision in 2020, going into 2025, strategically pivot from just absolute member growth to more focus on direct member growth. So, as opposed to indirect relationships like auto, third-party mortgages, promotional certificates, we see a lot of churn on those particular members, that are single product. And so we'll continue to do those things to complement, our other activities and to ensure that the balance sheet is healthy and so on. But, ultimately those relationships live for longer than the term of an auto loan, and we can get greater share of wallet, greater activity across everything that we're doing when we get a direct relationship. Tactically, our goal is to maximize the marketing performance through optimization of our spend, right? And so, working with you guys, really working top of funnel to bottom of funnel in terms of tracking to make sure we've got all the analytics we need in place. And when I say bottom of funnel, I mean funding of the product, not start of an application or the completion of an application. It includes the underwriting and the onboarding, of the new relationships. Really optimizing that funnel, making sure we're capturing everything, and then optimizing how we spend the money based on who's actually funding and becoming an engaged member with us. So that's another key piece of the puzzle for us. Solanki goes along with that, so we've got 5 or 6 lead products that, out of the vast number that we all have to offer, our checking, products remain strong. High yield savings, we've got a mortgage and HELOC all do well for us. So just really understanding the different personas within those groups that, respond most effectively to our product offering, and trying to understand, where the rest of those folks are across our markets. And then, so, in terms of products, we've got both a free and a premium checking. That's remained really strong in terms of growth for us. I mentioned high yield savings and home equity. The mortgage market's soft, but that's being said, our mortgage pipeline is looking quite good right now, considering the time of the year and considering rates. We feel good about all of those things. And I think that, it's not so much new stuff as it is fine tuning. We just did convert from Marketo to the Salesforce Marketing Cloud at the end of last year. So integrating that with the financial cloud and, driving more timely and personalized messages and offers will be an end result of that as well. But in terms of new is going to be more about products that we offer, functionality inside of digital banking, and things like that. So that's at a broad level what we're looking at this year.
That's interesting, right? I mean, on one side, driving acquisition, then persona, and then upgrading your MarTech, because tech stack upgradation is very much needed. So it combines almost all it connects dots across the life cycle, right? It maybe, okay, sounds good. Any one of you want to add your 2 cents? I mean, I won't pick up names, but, feel free to chip in.
Sure. I think you asked 2 questions: member acquisition strategy evolution, as well as marketing strategy evolution. If I start with member acquisition as a top of the house, and then marketing acquisition strategy, call it as a subset, it goes to the comment I started off with earlier, and the one that Fred picked up as well, which is the quality. For us, what quality of growth means is shift and mix into core membership, and examples include checking deposit accounts, business banking, wealth management. Those we call core, to try and grow those faster than the average, such that we can shift the mix of our products on both deposit side as well as loan sides into those that are more desirable, that have more longevity, more loyalty, more member value. And the way we do that is through a combination of product design, through promotions, through sales incentive for our front end folks, coordination in the back end. As an example, I will say the checking product that we launched last year, that has average balances that are a multiple of the average balances we had seen in legacy checking product. That product has a number of other product relationships, which is about 40% to 50% higher than the legacy products. It has gamer percentage, which is a third of what we saw in the prior products. So that's one example of just designing products to bring in that quality, which may mean that there are fewer people coming in for the same marketing spend, but then the quality of those same people is significantly better. And then what that automatically drives into is this notion of attrition, where we want to not only think about folks coming in, but the net membership obviously is a sum or net amount of inflow and attrition. So we are investing in both people and technology for understanding, managing engagement, retention, attrition. You use the word MarTech. We have a project underway for implementing a CDP, consumer data platform, for having the same level of personalization that we can then optimize marketing spend, optimize engagement of existing membership. So then if I go into marketing next, investing in targeting models, in response modeling to optimize cost to acquire. That can also mean using personalization segments, using personalized messaging, the ability to have optimization across channels to know when is the right time and the right messaging to convey to somebody. So from a marketing standpoint, the effort is going to be on going deeper, and that's where we would optimize the cost. And then the rest of it that I said earlier means that we have to have a coordinated effort across all other functions and the front end and the back end to be able to focus on that quality of growth, on that mix shift, and then strengthening that engagement after we bring somebody in.
Yeah, I can probably chime in a little more in terms of our marketing and member acquisition. We are traditionally a direct only organization. We've not done as much from an indirect standpoint. So from a quality, as Anand was saying, the idea of stickier membership is something that, we have had a great amount of success in with the direct model. For us, it's more about ensuring we have a uptick in active membership. There's just a lot of members who probably end up doing CDs or doing loans and stuff like that through us. But, being able to have a more sticky engagement is what our focus is, and wanting to develop that and continue to grow that. That is where our focus is going to be. Interestingly enough, we also have multiple channels. We have branches, we have the remote, services with the contact center, and we also have the digital platform, the one that I was talking about earlier. We do have a lot of really good engagement on that digital channel. So understanding, rather than being buzzy about it, there is an ability to kind of do a more omni-channel based marketing, giving the most relevant of input, in terms of what we are trying to do when it comes to member interaction. So that is the other piece that we are looking at. It's not just marketing praying and spraying. It's about the relevancy of the messaging and being able to do it in a consistent manner between all of our channels.
Yeah, I would add to that, very on the opposite side of the spectrum, we are a huge indirect shop. And so we really struggle with membership growth. One, because everyone is moving to Orlando. Every time we leave our parking lot, there's another credit union or bank right around the corner. So it's like everybody wants to be in Orlando. So the competition is pretty fierce. So for us, really, we get a ton of members through the indirect channel, but we're really trying to focus again on those core members and what are the things that we can do to attract those members to us. So we do a lot of things, like we tie special incentives for our loan products that we do on the direct side to some of our checking accounts, for example, because we figure if you're more engaged with us, we're going to be willing to give you a little bit more when it comes to lower rates, lower fees. So we've really taken that approach over the last year of trying to deepen some of those relationships. We have outbound calling teams. We try to hit our members from every angle, whether it be digital banking, through our QNexus pre-screens. Everybody has membership goals. So it's not just our branches. The people that work for me on the lending teams, our sales team members, they have membership goals as well. So while we want them out getting loans, we also want them out getting members and also trying to cross-sell deposit products. So it's really just making it a organization-wide focus, because it's something that we have to work at every day.
Sure, absolutely. I mean, membership growth is the highest priority of all credit unions, irrespective of geography. Obviously, Orlando is a place where everyone wants to be at. Even I want to be at, Miriam, but sadly, I'm not able to. I'm freezing in New York.
Yeah, Langley won't be there anytime soon.
Yeah, we're seeing Michigan, we're seeing New York, we're seeing all these credit unions from the Northeast coming down here and opening branches. So it's definitely interesting.
Great. Let's move on to maybe a question with Radha. So Radha, I want to ask you a question regarding technology, and not the fluff AI, but the actual AI, because all of us have seen the movement of, or rather evolution of AI from BI. I mean, that's what I talk about, the evolution from BI to AI, right? BI
Right.
was analytics, then data science / within machine learning, deep learning, and then eventually coming to what we call as AI. I'm very sad people nowadays refer a linear regression as AI. I'm very sorry about that. That should be the case. But my question is, how do you think is technology and AI moving from, I would say, enablement, being a cost center, to driving actual efficiency and driving impact? I mean, revenue impact is a very wrong word to use in this room, but still, we have to run a clean shop. You have to get revenue to make money, right? So, if you want to answer that question, how does it actually happen? I mean, when rubber hits the road.
Right. I mean, when you talk about, revenue, I look at it two ways, right? How is technology being used to cost avoidance and bringing new streams of revenue, right? There's both of those. One is both of them will, enhance your bottom line in, two different ways. And I believe technology in general and AI, the interesting thing is, the hype of AI seemed to be hitting a more steady state. It's moved from the hype to the realism of, what makes sense and what is relevant for the organization, from balance of risk and security, and the desire and the vision for where you want to use AI. Now, I agree with you. From a technology landscape standpoint, AI has become such a strong buzzword that anything that is remotely machine learning or analytics has had like a AI sticker slapped on it and being called AI. We recognize that. But what I see this year for us from a technology standpoint is moving from a piloting phase. There's like a lot of organizations when it comes to AI. There was a lot of experimentation that was done in the last couple of years, I should say. I see that extending into something real at scale. That is what we are moving towards in the new year. We've done about 7 different pilots, and we see opportunity to scale about 3 of them, and with several other things that are in the pipeline for us to be testing. So how do I see technology helping from a revenue or impact standpoint? Operational efficiency, being in the financial industry, paperwork, documentation, the amount of time it takes in terms of the value stream management is a huge focus for us. Being able to figure out ways in which we can create efficiency and the lead time reduction. That is definitely something that we see as an opportunity for us that will help us be able to acquire and manage faster. The second piece is around fraud, right? It's not direct revenue, but it is about, how much you're writing off and reduction, proactively being able to reach into members when it comes to, fraud, alerts, and being able to manage to those is the second area that I would say. Indirect way in which you manage your revenue. The third piece is the relevancy. I heard several of the panelists talk about, the relevancy of marketing. How do you acquire? There is a huge amount of technology components. If I end up giving you the most relevant offer, whether it's from pre-approval, what you need pre-approval on, when you need that pre-approval, that is another revenue stream. If I give you a more relevant offer, you converting is going to be faster, and there's going to be higher percent. In fact, one of the lending AI that we did pilot on was around pre-approval efficiency and conversion rates and stuff like that. And we've seen some good outcomes from the pilot that we will be scaling. So I see from an indirect standpoint, to summarize, there's all sorts of operational efficiency that we can work through, all the way from back office, front office, as well as human resources, fraud mitigation, and member engagement, and then ability to offer the most relevant things, especially if you have a omni-channel approach to it. There is a huge amount of value in terms of being able to manage to that across the board. So that is where we are focused on when it comes to technology and how we are able to provide to the bottom.
Sounds good.
Building on that, similar circumstance to what Radha just described it's across the organization. And I would say that deployment varies, depending on the area and the level of enthusiasm. But another way to look at it is buy versus build capability. And so we have bought software technologies with AI built in, verified, legitimate, not the vendor vaporware stuff. And, in some cases, so on the lending side, Zest AI is, we've been using that for over a year now and seeing real benefits from that. Also vendor pilots, in terms of, again, on the lending side with document management and things like that, really specifically focused on streamlining the application interactions and things like that. So I would say that where we've engaged with vendors in AI, we're probably further ahead than where we are on our own pilots. But we have done and are doing several pilots internally, so more build type of work. And then enablement is another word, because I think we're still socializing, these AI tools across the organization. There's various degrees of interest in them, degrees of resistance to them. And so socializing the technology, helping people understand how it can help them be more efficient in their jobs, speed things up, get rid of the dull work that they don't want to do. There's lots of opportunities in all of the areas. And I think, what we're doing there is we've got a group of different people from across the organization at different levels who are kind of an AI work group internally. We've kind of assessed where AI is throughout the organization, kind of maturation in each of those areas. So InfoSec is highly sophisticated through vendors primarily, but we have to be there, and fraud similarly. So it's still kind of a quilt in terms of how it looks, different capabilities, but we are moving to see real impact now, and I think we'll just see more of that in 2026. Greater adoption, and I think identifying more use cases where we can apply it effectively and see the gains from.
Yeah, I'll add on. We've also, on the lending side, we've worked with AI tools for quite a while now. We're in our 4th year of actually working with Zest, and we've seen the efficiencies it creates amongst the underwriting side. We've also seen that it's much more predictable of risk than our humans are. And so, 2 things we've been able to pick up is efficiency when it comes to providing members with answers. And 2, we've been able to really manage the risk within our portfolio because of us using the Zest score. And then we've layered in that also the fraud protection that they offer. And so we're really seeing some huge advantages there with AI being able to detect fraud in some of our loan applications. So I would say those are 2 of the biggest things across the lending side. But we also are trying to get all of our team members used to using tools such as Copilot, to your point of there are simple things that you do every day, writing memos or, simple administrative tasks that really can, go from an hour's worth of work down to 5 minutes if you're using some of these tools. So really getting our team members across the organization comfortable with those tools, understanding how to use them and how to use them responsibly is kind of where we have been over the last year.
Yeah, same thing, similar story. I would categorize AI into maybe 2 things. One is what I'll call endpoint usage through vendor systems, as most credit unions are, that we're not building any system in-house. We are integrating. We're buying licenses and then we are integrating them. So when we did our last assessment, we had about 30 systems that we found we already use AI in various different capacities that builds efficiency. So for example, anywhere from the usual use cases that were mentioned, fraud, to HR systems where you're writing a job description, or legal contracts that are like simpler things, or even more complex things such as use of AI in predictive modeling. This is the point you were mentioning earlier, Anurag, that the use of AI is so different now, colloquially, than it used to be when machine learning and AI were the original, where we still use the traditional AI in making predictive models. But here's another thing that we are exploring right now, and we've already started working, is on processing and funding indirect auto loans. So which is currently a fully manual process, but which can be completely automated, or by completely, I mean, other than exceptions that have to be manually reviewed, if we can automate 80% of all applications processed, because like you, Miriam, we are a decently good indirect auto shop, and so that's another good use case for efficiency gains and real bottom line impacts. The other pillar that I would say is the internal usage, and that's the kind that Miriam, you were talking about, of using Copilot or any other tool by internal functions to gain efficiency. The biggest thing that I see, or the biggest opportunity I see in that area, is the need to have all of our systems be integrated such that, at least as phase one, this Copilot or any other similar AI is able to talk to all of the disparate systems we have and gather insights. The next phase would be to take actions through these same AI agents, but we're not there yet. So that to me would be a massive step forward in terms of efficiency. This could even be eliminating the need for, say, for example, creating Tableau dashboards. We are a Tableau shop and we create dashboards, we refresh them, people download, people use them. Just imagine if we never had to then worry about those, and if there was this unifying system, an AI-based system that was natural language, and folks would just ask the question and they get the reports. So to get there, it would be very efficient, but then what that needs is what I said earlier about having all systems be integrated. So a lot of value that's ahead of us, but there's a lot of build out.
Absolutely. And the build out is very heavy, right?
Yeah, I think Radha was trying to say something, but
I'm sorry. Yes.
Your audio is not coming through.
Just figuring out, okay, on the audio.
Yeah, still nothing.
Yeah. Bill, she joins in, but Anand, that was very well taken. Do we have a back?
not yet.
Nope.
Looks like no, rather we can't hear you. That's fine. Technology gods are not kind. Happens almost every time. By the way, I don't even know if we are live on LinkedIn or not, because StreamYard gave me an error that there's some issue. But definitely this has been recorded for sure. In case audience, if you're not live, then we will record. We have this recorded session. We'll post chunks of each and every conversation over the period of 7 days, and we'll spam all of your walls for sure. So we're always there. Okay, so in the interest of time, maybe let's move ahead and let's have Radha join in. So let's go to Miriam. Miriam, I mean, I've been myself a risk analyst for a couple of years where I used to build underwriting models, but then life happened and I no longer build models. So my question is across change, right? The lending landscape is changing real fast. Gone are the days where we're doing manual approval. I mean, you're using Zest for I think it's a fourth year of you're using Zest. So my question is, what is changing the most in the lending ecosystem? Is it like products, writing, risk, or what do you think?
I would say it's automation. So to your point, gone are the days of somebody applying for a loan and us taking days to review it and then getting back to them and having them come into a branch to sign documents. Consumers, they want answers instantly, and then they want access to their funds instantly. So for us on the lending side, it's completely different today than it was when I started in this business 20 plus years ago. So I would say, getting those instant decisions, and not just on the consumer products, we're also looking at it on home equity lending now. You see many of these fintechs that they guarantee that they can have your home equity funds to you within days. So trying to compete on that level, but also still making sure that you're managing the risk that comes along with giving them those fast decisions. The risk that's associated just with consistent income, accurate income, or even fraudulent applications when we're talking about indirect dealers that are submitting the information to us. So I think it's really important that we stay up with technology and constantly evolve. Very much like the Zest platform, we're moving into more automation to where we can automate the closing and the funding. So members will get a decision instantly. And then from that, they're going to be able to close on that loan and get their funds instantly instead of having to wait a day or two. And I think that's going to be very relevant as we continue to move forward in lending, because people just don't have time to wait on the answers. And if they have to wait, they're going to move on to the next lender. So I would really say it has to deal with automation and response times is probably the biggest change that I'm seeing.
Yeah, we similarly put a lot of effort into the front end experience on the lending side. So we actually we went with Blend, who's a leader in the mortgage space and has been for a long time. We actually started with a membership and deposits with them a year ago and sorted all of that, got all of that implemented. So consumer lending just went live with them, and mortgage and HELOC will follow in Q2. So a couple things about that. One, it's a unified platform. There's other unified platforms out there now, but when we were looking, there wasn't. And so that was a big determining factor in the decision there. You know, as Miriam said, you want to get through an application quickly. You want to be able to provide the information that you need, both the stuff you know in your head and the documents that you've got to upload and things like that. So, and then even cross sell as they go through the process, and that experience, really has to be exceptional on a phone. When you think of, kind of the form factor that you're working with there, just to make a great experience, and then take in enough information that is useful and efficient for the back office to do all the evaluation and processing, represents a real challenge. And I think that arguably our industry has been a little behind on the user experience in regards to all of that. And user experience means the other things Miriam said as well: speed to decision and speed to funding. And so, and on the mortgage and home equity side, as soon as somebody pulls credit, they're getting bombarded with alternative offers and things like that. So it's not just about rate, it's about speed, it's about the best experience and the best responsiveness. So that's where we've spent our time.
Same for us too. Standardization of process, improving the controls within underwriting, swift decisioning, automated processing. That's one thing that I mentioned earlier as well. But then the additional thing I will say is that workflow integration of that automation. And what I mean by that is, after manually validating that an application has all of the information we need for decisioning, and then if it is approved, releasing the funding, that last part, that if there are enough checks and if there are no flags, then releasing the funding automatically rather than somebody manually clicking a button, that kind of workflow integration is also something we're working on. So there is all around, there is the benefits are not just that of efficiency, but there is also of experience, which is what I heard Fred and Miriam talk about as well.
Experiences are important. Integration is important. Standardization is important. The whole idea of balancing that with the risk and the compliance components is what we are working through. So the whole member experience is such a front and center thing. And while we talk about AI, there's just many tools like RPA, OCR capabilities that are going to be front and center when it comes to integrating some of these capabilities that we're talking about, whether it's underwriting or getting to a yes faster. There's just an ecosystem of tools that will come together from an intelligent automation standpoint and agentic AI capability standpoint. Interestingly enough, the biggest challenge there would be, how good is your data? And the second piece is, how well integrated from an architecture standpoint is your ecosystem to actually realize, any of those efficiencies. I think there's just a lot of foundational work that needs to be done in some cases if we don't have the right kinds of guiding principles, perhaps, on how our technology landscape has been built along the way. That is the piece that, we're working very closely to ensure we can go slow to go fast.
Thank you, Radha, for adding your sense. So in the interest of time, everyone, one last question. I know we are almost top of the hour. Maybe let's start with round robin again. Let's start with Fred, and then we'll go anti-clockwise. So Fred, one last question. What is that one capability credit unions you think must build in the next 12 to 24 months to stay competitive in the ecosystem? What do you think? What's your opinion on that?
Yeah, I think I'm driving folks here at Langley nuts with my AI evangelism, if you like. And we have spoken about that, but I think it's not just finding vendors and use cases. I think it's just personally keeping up to speed with all of the change and the revolution that's happening in the AI technology space. And so you and I have talked on many occasions, testing Claude against Gemini, against ChatGPT. I'm now in N8M and Zapier and working on workflows, and I built agents at home to do stuff. And I think good ideas come from that. So encouraging experimentation within our different teams, because their context will be different. They'll be able to think of use cases that would never cross my mind. And trying again to take the fear out of it. I'm old enough to remember the first mobile phone that wasn't very mobile and it wasn't very light. And I remember seeing the internet for the very first time. And the thing about them they were bad experiences to begin with, especially compared to what we have now. But they were just not great experiences. You couldn't hit the internet 10 times out of 10 when you're trying to dial in. And AI is building on all of that infrastructure, both internet and mobile, to create the 3.5 experience in ChatGPT was phenomenally better than the original mobile or internet experience. And so, and of course, then it's scaling so much more rapidly because of all of that. We're all faced with trying to keep up and worried about somebody coming up with a killer use case that puts us all out of business overnight. And people with bigger resources, budgets than what we got. But I think there's a tremendous opportunity for us in our organization to say, I know how I could use this to make something better for our members. And so it's really, I think we've got to spend time learning what these tools do. 10 years from now, we'll be really good at it, just like everybody else. We'll all be dead. But I don't think that's going to be the case. I think it's just going to be another tool that we'll have at our disposal. And the people that use these tools the best are going to be the ones that are the most successful.
Well taken, Fred.
Yeah, I that resonates so well with the way we think about it here. It's I'll say it is cultural activation for rapid change. So for folks, for people to embrace that change, and then creating the process agility that supports that base. I think I'm just rephrasing everything or summarizing what Fred might have said, but it's easier said than done, because for us, activate that level of hunger, that level of curiosity, and that level of change that we need to bring about is a huge step one. And then celebrating that, sharing that, evangelizing that change such that we then create processes and resources. That's the other interesting part, is that without creating the resources and pathways, that any change effort could fizzle out. So it's all of that combined is how I would anticipate for us to stay competitive.
And then I'll just add on to that, because I agree with what Fred and Anand has said. But I also think it's important over the next couple of years that we really start tapping into the younger demographic. The credit union member is really starting to age. And so I think we need to find a way to attract younger members so that we can remain relevant in 20 or 30 years. So we really need to listen to the feedback, make sure that we are evolving with our technology and the services that we provide to ensure that we have future members.
I think, that is a really critical point, Miriam. You were talking about, the whole idea of member acquisition, the segment of the population we are looking for when it comes to younger generation. Credit unions no longer are competing with credit unions. They are competing with fintechs. They're competing with a ton of innovative startups from a member acquisition standpoint. So it becomes extremely important that there is an innovation mindset that is balancing risk as well as the ability to appeal to the younger segment, because they are very used to these additional fintech offerings than the older generation that was probably a little more traditional when it comes to the financial interactions they are used to. So for me, innovation and being able to expand our horizon on who we are competing to acquire those members becomes extremely important.
I think if I hadn't gone down the AI route, I would have, I think parallel what Miriam said, user experience, I think, is the other, whether it's AI facilitated or not. She mentioned the fintech competition and so on, and they do an excellent job on just making it easy to do business, right? And so that's the other part of it, is just continuing to look at our technology, continuing to look at our processes in the branches and in the contact center, so we can answer a question quickly, give them the tools that they need to be successful financially, and whether that user experience is digital or in person or over the phone, just really facilitating quick, intelligent, useful answers to the inquiries that we get and providing, the right solutions.
Absolutely. This was a great conversation, in my opinion, touching across almost the entire life cycle of a member. But one standout was, I think we spent 98.5% of the time talking about AI. I mean, across multiple phases. But yeah, this is going interesting. Again, thank you everyone for joining in. And thank you, panelists Fred, Miriam, Anand, Radha. Thank you for spending this time with us and sharing your 2 cents on this year's priority. We really appreciate it. This was great. So again, thank you everyone, and I appreciate it.
Nice
Thank
to see
you.
you.
Bye.
Take care.